Mr. Market, the smart money, Wall Street. Lots of economists are calling for 150 to 200 basis point cuts by the Fed. Just to put that in layman's terms, that is somewhere between 6 and 8 cuts. Some of them are calling for this by the summer. Many of them are calling for it over the next year. And I do not know what they are looking at. I don't know if you saw the retail sales numbers on August 15th, but they were way above expectations. We got our weekly dose of unemployment claims, and they too were down. Are these just people hoping to be bailed out? Are these people that are in so much stress that good old Uncle Powell is their only answer? I don't know. Let's talk to Jonathan Twomley. What's going on, man? How you doing?
Hey, I'm great, Michael. Summer's winding down and I think people got a lot of time on their hands, so they're like inventing fantasies about what's going to happen in the market. I am very skeptical about big rate cuts coming. I mean, I've been skeptical for a long time. I remain skeptical. I think that you know, so many market players, whether they're in real estate or in the stock market or in the bond market, have never seen a normal interest rate environment in their entire careers.
Yeah.
And I think that there is just an enormous amount of cognitive bias for these people who say it just causes them to believe that we're living in a high rate environment and it has to come down. There has been no examples of the Fed like cutting this drastically absent a major recession. And there really isn't, there's rumblings of a recession, but the idea that like a major recession is around the corner that's going to justify, 2 points of cuts just doesn't seem to be there. And I think, we've seen this movie already before. The markets were predicting huge cuts not that long ago. They were all wrong, right? They totally, crapped the bed on this, on that bet. And I, who's to say they're not doing it again? I think there's a lot of reason to believe that they're just way out over their skis in what they're calling for. And I am skeptical. I think it's only a toss up as to whether we even get a rate cut next
Mm.
month, as everybody's predicting.
Wow. I like it. So toss up meaning 50-50.
50-50.
Yeah. So again, I think the September rate cut is a very interesting conversation. So let's talk about that specifically. So first and foremost, we have the following set of data coming. We will have the PCE reading that will come out in about 10 days. We will have a reading on PPI and CPI, and we will have August jobs numbers, all before the next Fed rate meeting. So let's talk about the August jobs numbers first. It was actually the weak, and I would argue very weak July jobs numbers that set off this rapid call for 50 basis point cuts,
Mm-hmm.
right? There was a moment in time where a 50 basis point cuts was over an 80% probability, according to the Fed Watch. That is now drastically lower. I have been tracking it because when you looked into the data of the July numbers, there was there were signs that the data was dirty because of a hurricane in Texas. Now, there's always noisy data, so and the Fed, to their credit, didn't flag it, so it was kind of like buried. You had to go looking for it. But what I decided to do, and I shared with my audience, is you know what, guys, let's look at the weekly unemployment claims that we get every Thursday morning. And sure enough, that Thursday we got a nasty number. It spiked to like 252. It was like, ooh, that's different. But again, was it the hurricane? So what I told my audience to do is we would need to follow the next two on weekly unemployment claims to see if it was a data point or a trend. Well, we've now had our second report this morning, and I'm happy to report both were down. We went from 252 to like 237 and then like to 223. So we are back to trend. So again, I don't know for sure, but it certainly seems like a possibility that the next jobs number will have a snapback. And what does a snapback mean? Two things. One, I think we had job growth of 118,000. That will probably be significantly higher. But most importantly, The large jump in the unemployment rate from 4.1 to 4.3 probably goes to 4.2. It goes backwards. So again, I ask you, if the job market is, you know, not falling apart as maybe the July report looked like, can you really cut rates? And oh, by the way, inflation still 2.9%. We'll get PCE in 10 days, but I don't know. I've been saying for quite a while, no September rate cut, and I'm not changing. If you put a gun to my head right now, I would probably tell you 60-40 that we get a 25 basis point cut. I think a 50 is a zero chance.
Yeah.
Um, but I'm still hopeful. I'm still going to stand on the island of no rate cuts in September.
Yeah. I mean, I'm leaning more in your direction than not. And I think, you know, a lot of what I'm seeing are people who are posting for big rate cuts, right? They're still referencing the SAM rule, despite the fact that Sam herself, Dr. Sam
Well,
herself, has said this doesn't apply. But this is what I mean about this kind of like the cognitive bias, wishful thinking. They continue to rely on data that the originator of the data says doesn't apply, right? Because, well, why let some facts get in the way of like what you want to happen? And so I think that the data is leaning against it. I also think that, the Fed kind of needs to tread warily as well, because if there is a rate cut, right, it's going to send the markets into a frenzy of wanting more, right? And so it's going to
yes.
drive interest rates down even further, right? And I think the Fed has got to really walk kind of a fine line and make sure that the data really supports a rate cut before they issue a rate cut, because I think the market is just going to go bonkers at the first sign of rate cuts, right? And so not only could that spark inflation again, it'll definitely spark asset inflation again. It'll cause the stock market to go even further into bubble territory. And that's where you get the real danger, right? If we do have like a stock market meltdown because the stock market inflates a bigger bubble that then gets pricked by one little tiny piece of negative data, right? That's going to be a bigger problem than keeping interest rates where they are. So I think the Fed is not. I just don't see this like 100% certainty of a rate cut at all. I think there's a good chance there's no rate cut at all, and I definitely do not think we're looking at 2 points of rate declines over the next year, absent something that we're just not seeing now in the economy. And just another point I'd like to make, okay, the SAM rule. Frankly, I think if the SAM rule thing had not come out, nobody would be even paying the slightest bit of attention to what is it, 0.2%, going from 4.1 to 4.3. Normally people would look at that as noise, right? Now, because of the SAM rule, where this is like three in a row from the trough of unemployment, people were like, okay, look, it's a trend now. But I think without that rule, a lot of people would be like, yeah, the move from 3.8 to 4.3, like we're still under full employment. And I think if the next employment report shows that unemployment rate ticking down or even holding at where it is, that's going to just, like all bets are off then, because I think the Fed will look at that and be like, oh, too early to cut. Right.
Yeah.
So yeah, we're just not there yet. I mean, people feel like the economy is hurting because prices have been up for a lot. Prices are up 20% or whatever over a couple of years ago. So people feel bad about it. But all the other data is that they're still spending money hand over fist, right? Employment is high, wages are growing, rents are falling. Like, where's the bad news other than that it costs you more at the grocery store, right? I mean, gasoline prices are down from where they were a while back. Like, it's people are traveling like crazy. It's just like, where's the bad economy other than, like I said, who wants to pay more for stuff? But that doesn't make it a bad economy.
Yeah, so let's talk about Claudia Sahm. I read a lot of her articles because she came out and said, "Hey, my rule doesn't apply in the current environment." So what does that mean? Again, I think Sahm rule, let's be clear, got a lot of credit because it was accurate the last 8 times. but the dreaded "this time is different" is true, according to Claudia Sahm, the creator, Dr. Claudia Sahm, the creator of the rule. She basically says that her Sahm rule is a demand-based rate of change. What does that mean? Basically, it tracks the loss of jobs or demand for workers in the unemployment or in the workforce. And what Claudia Sahm has accurately pointed out is this time is different, meaning we have seen a significant supply shock,
Yes.
which is not included in the Sahm rule at all. So, what does a supply shock mean for labor? It means we have freaking open borders, and we have invited or let in, or whatever you want to call it, millions of people that have distorted the supply side. And Claudia Sahm is my rule doesn't apply when there's a supply shock for labor. So that's what she's pointed out. She has done some back of the napkin math, kind of trying to account for the supply rule. And basically, she estimates that we are actually at 0.25. And why is that important? Because the Sahm rule kicks in when you have a rate of change double that. So she's looking at this going, guys, we're nowhere close to a problem. So that was really what Dr. Claudia Sahm had to say. And again, if the creator, I got to take her at her word for what's going on, because she could, let's be clear, if she wanted to be on every news network, she could have played that Sahm rule up because everybody's talking about it. She could have been on every news feed, and she's not. She's like, hey, doesn't work. And kudos to her for being intellectually honest with all of us. So Claudia, nice job.
Right. And to your point, just to your point, like the number of people who are employed continues to grow, right? So the Sahm rule can't, right? That's the thing. The rate is bouncing around because you've got both a numerator and a denominator in this
Correct.
equation,
Numerator and denominator,
right? But the absolute number of people with jobs in the economy continues to go upward, right? So it's like until that trend goes into reverse, that's where you have the recession, right? If I understand what the Sahm rule is about, it's actually about the number of jobs has to be starting to decline, not the rate of employment, but the number of people who are employed. Like that number has to be the one.
Demand for jobs. Yep.
Yeah.
Yep.
So as long as we keep on having positive growth for jobs, right? And I mean, it's kind of amazing that despite, it just shows you how, in a way, what you're saying about like, we've got all this immigration happening, right? And it's increasing the supply of labor. I mean, the fact that the economy continues to absorb all this labor that's coming in. I mean, that's why it's coming in here, right? If there were no jobs, it wouldn't be coming, right? So it's like the fact that the economy is so robust that it can continue to absorb all this immigration and with barely like registering at all, again, is another data point that says, really, rate cuts, are they justified? Not so sure, right? So, and everywhere like if you're in a business like I am, where you actually employ people, right, in the hotel business, the constant refrain is, we can't find anybody. This isn't this bullshit of nobody wants to work. That's BS, right? It's that the demand for labor is so high, right, that you can't, it's just very difficult to find people. People have lots of options. You have to be willing to pay them to get them to come, right? If you, and it drives me crazy every time I see this. Like I see these jobs advertised for like, minimum wage essentially. And it's like, you really think you're going to get somebody for that? Like, and then you're going to go and complain, nobody wants to work anymore. Yeah. Nobody wants to work for peanuts anymore, right? They can go down the street and get a higher paying job. They're not going to come to your place and, where you're going to pay them peanuts and probably abuse them too, because you're that kind of person, if that's what you're offering. So, we try to pay, sorry on this rant, but like we try to pay the highest wages in the market because we know we'll get the best people. Right. Yep. And still it's tough to find people because they have options.
Yeah, the other thing that I think is going on, there's two other things we want to talk about here. One is a rolling recession and one is a soft landing. So let's go to soft landing first, because I actually read an article on it this morning. Alan Greenspan is credited with engineering the 1995 soft landing. And what did Alan Greenspan do? He basically started tinkering at the edges, meaning some rate cuts, and produced the only soft landing in modern history, according to articles that I've read. And this is where I think it's fair to say that at least Jerome Powell and team are watching. Why? What could that mean? Well, again, if you think about what's called R star or terminal rate, or how restrictive the Fed funds rate is, there's not a number, there's not a number, there's not a calculation. It's a feeling, it's a gut feeling. But one of the things I do think the Fed is watching is how restrictive they are. So what does that mean? Well, right now we are at 5.25 to 5.5. Let's just say inflation is 3%. It makes the math easier, which means you have a delta of 2.25 to 2.5. If inflation falls to 2.5, again, to keep the math simple, we are actually more restrictive by about 25%. So I do think that in the future, again, not September, I believe Powell, if he wanted to, could tinker in November or December. And I'm talking maybe 50, maybe 75 points of cuts in the next 6 to 9 months. I could see that happening. What say you?
Yeah, well, if that's the way they're making their decision process, then yeah. And so listen, you're the economist and I'm not, so I will trust your kind of gut on that sort of thing. But I do want to point out that, the soft landing that Greenspan engineered arguably fed the dot-com bubble, right? Which
Sure.
then I think it's pretty clear that if you read a book like Irrational Exuberance, the dot-com bubble directly fed the GFC, right?
Great
So
read. Yep, totally agree.
the soft landing and rate cuts. I mean, I think that the Fed has to be looking at that as well. Like, what are the knock-on effects of lowering rates even if you engineer a soft landing? Well, what's going to happen a couple of years from now as a result of these rate cuts? Is it going to lead to something worse? And
I completely agree.
so I think that that's got to be part of their thinking as well, about all of this stuff. And listen, I don't envy their jobs. I mean, they get a lot of crap from everybody who tells them that they're wrong no matter
Everybody's
what
an
they do.
armchair quarterback.
Yeah, everybody tells them that they're wrong no matter what they do. And then there's the conspiracy theorists and everybody else. But these guys have a lot of training and a really hard job, and they take it very seriously, and they really think this stuff through. And they have like armies of economists working for them to help inform their decisions. And they make the best decision they can, but they'll always get it wrong in the view of half the people, right? So, not
Yeah.
an easy job to do.
Well, let's talk about the big elephant in the room. And I started talking about this on my channel about 18 months ago, and I'm actually starting to feel even better and better about it. And that is, we're going to experience our first real cut at what's called a rolling recession. Rolling recession is where parts of the economy contract while other parts of the economy grow. I think the easiest example, again, on my channel, given a real estate channel, is to look at what happened with real estate transactions. Existing home sales has gone from roughly 6 million to sub 4 million. That's 2 million less transactions. And when you realize that there's, I don't know, 8, 10, 12 people that take a piece of every transaction, you can really see that drop. And on the other side of that, to your point earlier, look at travel, right? Look at travel going up. So again, I think really what's confusing the armchair economists, and probably creating a lot of consternation in the Fed, is a rolling recession. Because again, given history, the only one that people kind of point at is 1990, and that was kind of a rolling recession. But a lot of the people, to your point earlier, have only experienced, the kind of elevator recession where it all falls apart at the same time, whether it's the .com, the GFC, or COVID. It was just all over a cliff. The Fed must cut 200, 400, 500 basis point. We got to go back to zero. And the rolling recession is not that. And it would require the Fed to be more, careful. I think a rolling recession is what we are. Actually, I think it's what we are experiencing, and we won't know about it for another 6 or 9 months.
Let me ask you this, because I'm not really familiar with this term, but like what differentiates that from just a normal old-fashioned recession? I mean, it always seems like there are parts of the economy that do okay, other parts of the economy that suffer. I mean, we also know that real estate is not necessarily, it's not directly correlated to the general economy. So there have been real estate crashes and real estate recessions while the rest of the economy has been doing fine. Like the late 80s is an example of that, where real estate just tanked, but the economy was fine all along.
Mhm.
So, what's the difference
So the
between just
biggest, yeah,
softness in general and
mhm.
like a rolling recession?
So the biggest difference is for the average person looking at this is you can watch GDP growth. So again, GDP growth in a rolling recession will be below trend, could be slightly positive.
Mm.
Again, the ones that are growing outweigh the others, and it will be an extended duration. It won't be a quarter. It'll be 2 or 3 quarters. It's rolling recession. Again, it's all theory at this point. We've got one example to look at, the 1990s. I would expect a rolling recession and below trend growth. Let's put some numbers on this. I would expect if a rolling recession is identified, we will have GDP growth somewhere between negative 0.5 and positive 0.5 growth. It will be kind of that band, and it'll be for 3 quarters. It'll be one of those things, because again, you'll have one part of the economy doing okay, another one sucking wind. And we won't know about this for a while, because all these numbers go through 3 revisions, right? The initial print, the second revision, the third revision. So that is kind of the, I don't know, 10,000, maybe 20,000 foot view of how somebody could watch a rolling recession.
So it's kind of like just a very sluggish economy that's not really
It's just,
tipping into recession. It's sort of like just dragging along the bottom and
yeah.
just sluggish, and yeah.
And some people, really what happens at the individual level in a rolling recession is you do see people leave fields,
Hmm.
right? I.e. real estate, right? We have 25% less transactions. People can't pay the bills. They're going to transition to someone else. So the other thing you can look at, if you want to get nerdy with it, is people going back to school or skilling up or getting some certifications, because they got to go become the AI expert or the data scientist or something else, right? They got to
Right,
they
right,
got to
right.
get out of this field that's struggling, and they go to this new field. So that's kind of in the weeds, but that's the other thing you might see in a rolling recession.
Got it.
Yeah.
Makes
So
sense. I mean, we're definitely seeing that in commercial real estate too. I mean, there's talk that between, 10 and 50% of all mortgage brokers have left the business. And, same thing for real estate brokers, because they're just not making it. They haven't made any money for 2 years, and everybody's savings has run out, and they've got to go find other jobs. So we're definitely seeing that with real estate for sure.
yeah, I have 3 mortgage brokers on my show every week, and they told me, I think this is 4 months ago, that more than 50% of mortgage brokers are out of the business, or
Yeah,
more loan originators or whatever they call themselves. Yeah, out.
not surprising at all. Yeah.
Yeah. Well, let's talk about rent and the boom in refinances, because again, I don't know that people really understand what this means to households. We'll do mortgage refi boom first, because that's actually something I called and got right. Mortgage refis were up 35% week on week, 117% year on year. What does that mean? Well, when you look at a mortgage refi, what does it mean to a household? It generally means you are doing a rate and term. You're going back to FHA or VA, and you're lowering your monthly expenses. Okay, what does that mean? That means you have more discretionary income. If your mortgage payment goes down 180 or $200, it means that is net positive. That means you can spend that $200, you can save that $200, you can pay down debt with that $200 on a credit card. Again, if we do see rates fall slowly and this refinance boom continues, that is net positive. If you want to flip it to the other side, if we see a boom in equity extraction, cash out refis, what does that mean? Well, that could be a couple of things. It could be people paying off and consolidating debt, net positive. It could be somebody taking out cash as a reserve for bad times. Again, okay. Or it could be, people, investing in their house, putting in a backyard, going to college, starting a business, whatever. Watch refinances, folks. In the residential housing space, we have never had this much equity that we could extract. So as rates fall, you would be remiss not to watch refinances. Let's just make it really, really clear. If rates fall 50 basis points and the refinance boom continues on steroids, that will be a lot of cash sloshing around in the economy. What do you think of all that?
Yeah, I mean, absolutely. I don't know how exactly to measure that effect, but it certainly is an impact, right? So people have less money that's going to mortgage payments, and they're taking money out of their house. I mean, this is like the wealth effect, right?
Exactly.
This is why the Fed always, they actually love cutting rates, right? Because they stimulate the economy. This is one of the biggest stimulation impacts of rate cuts, right? It's not just well, businesses will have cheaper borrowing costs. It's that homeowners are going to go and say, wow, my house is worth more. I'm going to refi and I'm going to spend this money. Or, I'm going to refi and have less, my monthly nut is going to be smaller and I'm going to spend more money. That's what they're doing. I mean, I personally think this is, it's sugar water for the economy. I really don't like it. I think it
Yeah,
actually
absolutely.
increases the wealth gap between the haves and have-nots. I mean, it rewards people who have houses. It punishes everybody else. But it's one of their tricks that they like to do, and it works on the broad, on the overall economy, right? It definitely helps. So I agree with that. The
Yeah.
rents, I think you were setting up to go this way too. Now, one of the interesting data points that's come out recently is that rental affordability is now back to where it was before COVID. So just if you remember, during COVID, we had all this people moving around, right? They were moving out of the cities, they were moving out of roommate situations, they had to be, socially distant and everything. And that just drove, plus the stimulus tax that everybody got, just drove an incredible amount of rent growth across the country, right? Because the demand for apartments just skyrocketed, right? Also, people were not out there spending money on other stuff. They weren't going out to restaurants. They weren't doing all kinds of stuff. So they had more money to spend on rent and they wanted nicer places to live. So they were willing to spend more, right? That basically has gone into reverse as a number of trends has happened. People have moved back to where they were from, right? There's a massive building boom across the whole country, but especially in the Sun Belt, right? And these massive rent increases have just basically burned off. And so now where we are is rental affordability is back to where it was before COVID, which again means that people have more money in their pockets to spend on other stuff, right? They are not spending this disproportionate amount of their income on rents the way that they had been for the last few years. So again, talk about like tailwinds to the economy, right? That's a big one. And that's also going to have an impact. So just more money sloshing around that people are not giving to landlords, right? So it's what they're
Yeah.
spending on other stuff.
The other really interesting thing about rent is I had assumed, I knew that rent, when you're doing the CPI, the inflation calculation, that rent was a lagging indicator just
Yeah.
because of the mechanism that they're calculating it. But I don't know if you saw this. Rent, owner's equivalent rent inflation was up month on month, which boggles my mind because rent, at least by that real-time data, is slightly negative when you take housing and apartments together. So the fact that the data is still reporting a roughly 5% increase in owner's equivalent rent inside CPI and rent or shelter is 37, or I think it's 37% of the inflation calculation. If you simply take 5% to zero, and then you have an impact of 37%, you actually have CPI below 1.5.
Wow.
It's like, wow. I mean, why is anybody doing that math? It's crazy.
Yeah. Well, I think there are people doing that math, but not the Fed. So
Yeah, not the Fed's looking at the rearview mirror. It's like this
yeah,
big. Yeah.
yeah.
Yeah, and you're
So
absolutely right. I think there's a website called Trueflation. Shout
yeah.
out who's ever running that. I think I haven't looked in the last couple of days, but they have inflation down at like 1.7% because again, I think they have like 5 or 10,000 metrics that they update weekly or daily, Monday through Friday. And it's been remarkably accurate. So again, go look at that, pal. You've already got, below 2%. So pretty crazy. So the last thing we should talk about here, again, going back to the topic at hand, is 200 basis point cuts in short order. I want to flip the script and say they're right just for a moment. The thing that I'm always left with when I look at that drastic, and it's basically repeating the playbook of COVID, of the GFC, of the dot-com crisis, is all I can say, Jonathan, is be careful what you wish for.
Yeah.
If the Fed is backed into a corner where they have to cut 200 basis points in a short time frame, something nasty broke. That's what I'm thinking.
Yeah. And listen, I don't think, back to our discussion about whether the Fed is being too restrictive or too loose, right? I given the fact that a 200 basis point cut cumulative implies like a serious economic distress situation, I don't think the Fed will cut that much, like just because they feel they're being a little bit restrictive, right?
Mhm.
Like they'll be fine with being a little bit restrictive if the economy is not overly burdened by being a little bit on the restrictive side,
Yeah.
right? So, but like you said, the 200 basis points of rate cuts are not going to come just because the Fed thinks, oh, we should just like cut everybody some slack and cut rates, right? They that's going to come as a result of the economy being really bad. And if the economy is really bad, then like all the people who are rooting for rate cuts, like watch out, because it's going to
Careful
mean
what you wish for.
it's
Yeah.
going to hit you on the demand side, right? It's going to hit you on that is going to mean that people are out of work, right? And when people are out of work, they don't pay rent, right?
Mhm.
So that is not a situation that you want to be in. Like this, the whole idea that we're going to be in some kind of like Goldilocks situation where we get 200 basis points of rate cuts, but the economy is still chugging along fine, ain't going to happen. Like this is just not the way the world works, right? So I think that's another reason why this whole like 200 point rate cut narrative is just doesn't make any sense, right? It just doesn't track with what like economic reality is, but it definitely goes back to this massive number of people who know nothing but this ultra low rate environment and think that's normal and think that we have to go back there or like the economy is going to fall apart if we don't go back to ultra low rates. And it just is not true, right? It's just
Yeah,
not true.
something I've believed and said since August of 2022, when infamous speech from Jerome Powell at Jackson Hole, where he threw away his prepared speech and did kind of a 7-minute speech off the cuff. They basically said, "I'm coming for you." What I think he said back then, and I have receipts, is he's trying to kill the Fed put. All right, what does that mean in layman's terms? He does not want to bend the knee to Wall Street. Earlier in the week, I guess it was last week, the market had a tantrum because of the yen carry trade. We talked about it last week. Thank you very much. We had Jeremy Siegel come out, whine, cry, bitch, whatever, wanting 75 basis points, emergency cut, which would, of course, as we covered last week, been just as disastrous. The Fed doesn't care about the stock market. It doesn't care if there's a 3, a 6, a 9% loss in the stock market. The stock market going up is not the Fed's job.
Yeah,
And
exactly.
Jerome Powell is not going to bend the knee to Wall Street losing money. He's just not going to do that.
Right. And we saw exactly what we saw what happened. It just bounced. It was like nothing happened. Right. We're back
Yeah,
where we were.
within a week.
Yeah. Yeah. I mean, within 3 days. Right.
Crazy.
So yeah, and I said it before, it's sort of like on a related topic too. Like it's also not the Fed's job to make Congress's job easier with low rates. Right.
Absolutely.
Like
Yeah.
they're with all the people, and I can't tell you how many times I've heard this ridiculous assertion that the Fed has to cut rates because of the federal deficit. No, they don't.
No, they
It's
don't.
not part of their mandate, right?
No.
They're not in cahoots with Congress. They're not making Congress's job any easier. That's not part of what they do. And frankly, they may be thinking exactly the opposite. They may be thinking we got to wean Congress off these low rates too, right?
Yeah,
In addition
exactly. I agree.
to getting the Fed, getting rid of the Fed put, maybe they got to get rid of the Fed put for Congress too. That could be in the back of their mind, right?
I couldn't agree more. Yeah. So at the end of the day, I think it's going to be very interesting. I really don't think a September rate cut is a lock. I think there's a lot of people that do. The other thing I want to throw out there, just because it's how the calendar works, we have a November election. And I believe Powell and the Fed when he says he doesn't want to appear, to bend the knee to either party. I think a September rate cut of a quarter point when the data is not extremely clear
Yes,
is
I
a
agree.
misguided calculation.
They're going to need to feel like it's unassailable, because they know they're going to get it, if they appear political or whatever. So they're going to want to be able to say there's an absolute need for a cut. And
Yeah.
we're willing to take the heat because of the need for the cut. And I would like to also just sort of, something just popped into my mind. as a kind of a maybe last topic of conversation.
Mhm.
So I'm sure you saw the other day Trump talking about how the president ought to be able to have influence over
Mhm.
interest rates,
Sure.
right? Now, I think I know what your opinion on this is, but what is your opinion on whether whether the interest rates should be politicized, you know, with the president being able to influence interest rates?
Well, I guess it always boils down to influence. So I think the fact that the president has an opinion about interest rates is completely valid. I think I think
Sure.
I think running the I think running the country is running a business. That's what I think a president is. And believe me, I don't want that job. So I think having a president that's in tune with the economy and has his own opinions is completely valid. I think it's completely valid for him to bring in Jerome Powell and his cronies in the room and share his opinion. I believe at the end of the day, the Fed has to remain independent and has to make their own decisions on their own. So I I fully support the independence of the Fed. My hope is, again, we go back to Paul Volcker telling Nixon to F off when Nixon wanted him to start cutting rates. He's like, no, I can't do that. My job's the economy. But I think it's completely fair to Nixon to call him in. I think it's completely fair for Trump to have an opinion. It's okay.
Yeah, absolutely. Yeah, it's absolutely the president is entitled to weigh in on the issue for sure. But
Absolutely.
that's not, as far as I understand, what was being proposed. What was being proposed was the president ought to have a say, essentially like ordering the Fed, right, to do what they want.
Uh,
That may
you
be
got his
that.
vocabulary is very,
Well,
British and
this is the way a lot of people interpreted it in social media. So
sure.
let's put it that way. So
Well,
whatever
the
Trump,
news media is being unfair to Trump. Shocking.
no, I'm talking about people on LinkedIn who were saying,
Oh,
yeah,
okay.
no, this is a little bit different. This is not people criticizing Trump. This is people saying, hell yeah, the president ought to be able to tell the Fed what to do.
No, I totally
I saw a lot of
no.
this on
I
LinkedIn.
no.
And
If the question is should the president of the United States set interest rates, the answer is unequivocally no.
yeah,
Not
absolutely.
not experienced, doesn't have it. They have a lot of other broader views, just like Congress. I mean, again, let's not forget the president doesn't spend money. It's Congress,
Yeah.
except in extreme, emergency things. So I don't want Congress yanking the Fed's chain either.
Well, not only that, but let's just play this out. Just do a very simple thought experiment,
Sure, I
right?
like it. Mhm.
If politicians controlled interest rates, would there ever be an interest rate hike ever? Ever?
No, no.
No, there would never be an interest rate hike if this was up to the president, because whatever party doesn't matter. Not picking
Yeah, and
on
again,
Trump. Yeah,
I'll even go one back further. Let's just say in 1980, I think that was Reagan.
yeah,
Um, interest rates are 5%. And again, he can call the shots. You know what happens in 84? We talk about 4.75, and then 4.5, and then 4. And then we just go one direction until we're at zero.
yeah. No, exactly. That's what I'm saying.
Yeah.
And not and then talk about like, well, people are like, oh, the Fed's not going to cut because they are worried about the appearing political. Well, if you just make it political, I mean, what do you think is going to happen every single?
Every
I mean,
time.
yeah, I mean, we would wind up with like such negative interest rates and like a completely crashed economy.
Yeah. That's why I think
Ultimately,
a
yeah,
September rate cut, at the end of the day, 17, 18 people in a room, unless the data is like unassailable,
yeah,
they're going to go too hard. Too hard. Not now. Not this time. And that's why my stance has always been they're not going to cut in September, but they'll go a half in November. It'll be kind of the makeup cut.
so
Like,
after the election, you're saying. So
yeah,
once the votes are in, they'll be like, okay, now we have free hand to do what we want.
yeah,
No
now
one's
it's
gonna,
done. It doesn't matter,
yeah,
50 base. I've been saying that for 6 months. So I'm going to still stand on that island. Although I'm only about 60-40 that way now because I think there might be it's not going to be clear. And I hope they have the balls to say, you know what, let's wait till November. We'll see.
yeah. Well, listen, I think just again back to the theme. If it's not clear, there really isn't any justification for cuts, right? So
I agree.
even though there's all these people saying, oh, they're always too late with cuts or whatever. I mean, listen, I think the argument that they were too late to raise makes sense, but
Oh, of
too
course.
late to cut. I mean, they can cut very fast,
Oh,
right? If they need
exactly.
to,
They
right?
they know
So
how to stop it.
yeah, they can cut really, really fast and cut a lot. So if they happen to like miss by a month or two and they're like, holy crap, right?
6
They'll
weeks.
just,
It's 6 weeks
yeah,
from
the economy
September to
just,
November.
yeah, absent like some kind of like major, who knows what it could be, like,
World
Israel
War
and,
III starting.
yeah, right.
World War
Israel and
III.
Iran
You're
getting into an
you're
actual
cutting.
like real
Yeah.
war, right?
Ground war. They're cutting.
Yeah,
Yes.
that could do it. But you know, and listen, I know we're supposed to like wrap this up, but
It's okay.
I mean, have you been like watching, like, somebody pointed out gasoline prices or oil prices, like, with all
Mhm.
the turmoil in the Middle East, they're
Yeah.
supposed to be going up, but they're going the opposite
Yeah.
direction.
Gas
I
is
mean,
down according to CPI. I think it was 3.1% month on month.
yeah. So
There you
I
go.
mean, the data is just all over the place, and that doesn't. When data is all over the place, it doesn't.
No,
The Fed
clear
needs it to be.
cuts, not. Yeah.
The Fed needs it to be all pointing in the same direction, or most of it pointing in the same direction,
Yeah.
right? There
And
needs to be a trend.
let's just wrap it up. So let's pretend the election wasn't November, this November. Let's say it was, 14 months from now.
Yeah, right.
I mean, I don't know. Maybe you cut a quarter just to kind of, try to feather it in, but that's not where we are. We have an election in November. You don't want to appear political. You've said it a gazillion times. Unless the
But
data's assailable, you can't cut.
but I would say even if the election were next year, it's still a toss up, because
No,
I think that this.
I agree. I think it's a toss up, but we have an election. And I think that fact is going to make it less than a toss up because I cannot imagine them wanting to deal with the heat for not a clear and concise cut. I mean, I don't see it. And especially, again, like we talked about earlier, unemployment rate goes down from
Yeah.
4.3 to 4.2.
Oh yeah.
Inflation is still 2.9. I mean,
Yeah. If it
it
looks like
doesn't
that,
seem clear.
they're not cutting. They're not cutting. Yeah.
I agree. I agree.
Yeah.
Well, Jonathan, you are amazing. You do a lot of great work. You're all over LinkedIn. How can people follow you?
Well, yeah, come to LinkedIn. And by the way, right now, as we speak, if you go to my LinkedIn profile, you can download a free course that I put together on how to get brokers to show you good deals, even if you're not experienced. So if you've
I
been
like it.
struggling with trying to get deals from brokers, good market, bad market, doesn't matter. Go download this free course, 10 videos. It'll walk you through the whole process that my students have used to get deals, even though they've got, no track record. So
Awesome. Thank you so much.
absolutely.